Ladies and gentlemen, good day and welcome to the Affle India Limited second quarter and half year ended FY 2022 earnings conference call hosted by Prabhudas Lilladher. As a reminder, all participant lines will be in the listen only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I would now like to hand the conference over to Mr. Aniket Pandey from Prabhudas Lilladher. Thank you and over to you, sir.
Thank you, Janice. Good morning, everyone. On behalf of Prabhudas Lilladher, we welcome you all to Q2 and H1FY22 conference call of Affle India Limited. I take this opportunity to welcome the management of Affle India Limited, represented by Mr. Anuj Khanna Soham, who is Chairman, Managing Director and Chief Executive Officer of the company, and Mr. Kapil Bhutani, who is Chief Financial and Operations Officer of the company. Before we begin with the discussion, I would like to remind you that some of the statements made in today's conference call may be forward-looking in nature and may involve some risk and uncertainties. Kindly refer to slide 21 of company's earnings presentation for a detailed disclaimer. I will now hand over the call to Mr. Anuj Khanna Soham for his opening remarks. Thanks and over to you, Anuj.
Thank you. Good morning, everyone, and thank you for joining the call today. I trust all of you are keeping in good health. Affle delivered a landmark performance anchored on our entrepreneurial culture, tech innovation, and continuous execution focus on sustainable value creation, powered by our Affle 2.0 strategy. We concluded the quarter with highest revenue, highest conversion, highest CPC rate, and highest EBITDA and PAT to date. We delivered revenue growth of approximately 104% year-on-year and 80% quarter-on-quarter this quarter, and achieved Q2 revenue CAGR of 65.7% over the last 3-year period, much ahead of the industry growth trend. Our CPC business noted a strong momentum, delivering 48.7 million conversions during the quarter, an increase of 73.3% year-on-year at an INR 51 CPC rate. Our growth is broad-based across our top industry verticals and from both India and international markets. Powered by our ROI-linked CPC business model and unique position in the industry, we continue to grow as a preferred mobile marketing company across global emerging markets and beyond. Our India and international contribution, historically balanced at about 50-50 each, has now shifted in favor of international on account of our successful integration of Jampp and our efforts to build local on-ground presence in newer international markets. The contribution stood at about 66% international and 34% India in this quarter. Our focused execution on Affle 2.0 strategy has enabled us to drive deeper verticalization for our advertisers across the EFGH industry verticals. This has strengthened our moat, and our direct customer contribution has grown to 74% of our revenue in H1 FY 2022 versus 57% in FY 2020. Our consumer platform propositions, tech IP portfolio, and all our organic and inorganic investments are performing well in terms of profitable growth momentum. And we continue to establish new thought leadership benchmarks in our industry globally. We won 81 recognitions across categories and geographies in the recent AppsFlyer Performance Index. Apple's AppNext platform was recognized as the number 1 non-self-reporting network platform globally on Retention Index for Android in the non-gaming category, and Apple's Jampp platform was rated among the top 10 platforms globally on the SCAN Index Power Ranking for iOS. Our consistent focus on R&D and tech IP creation has consistently delivered value to our customers and partners. We are thrilled to be granted 3 recent patent grants in the US, taking our total US patents granted to 6 as on date, with 14 other patents filed and pending across jurisdictions, having many applications and use cases for the the future. I'm incredibly proud that Affle, for the third consecutive time, won the coveted Enabling Technology Company of the Year at the MMA Smarties India 2021, and this is organized by the Mobile Marketing Association. This is a significant win, and this came together with 7 top campaign awards for Affle's innovative mobile marketing and advertising campaigns. To ensure deeper understanding and appreciation of Affle's consumer platform use cases, we have included 3 additional case studies in our earnings presentation showcasing the power of our platform to deliver consumer conversion and drive value for our customers. With the fundamental shift happening in consumers' lifespan towards mobile screens and connected devices, we remain optimistic of the global market opportunities, and we continue our investments to enhance our market penetration. With that, I now hand over the call and discussion to our CFO, Kapil Bhutani, to discuss the financials. Thank you. Over to you, Kapil.
Thanks, Anuj. Thanks everyone for joining the call. Wishing everyone a good day and hope you are keeping safe. Continuing our year-on-year strong growth momentum in Q2 financial year 22, the company reported a revenue from operations of 2,747 million, a growth of 103.6% year-on-year, and sequentially on quarter 2 increased by 80.2% quarter-on-quarter. We have seen growth in revenue coming across the verticals and platforms in all geographies. Our H1 revenue stood at 4,272 million, a growth of 90.1% year-on-year. Our EBITDA for the quarter stood at 521 million, an increase of 51.1% year-on-year and 48.6% growth quarter-on-quarter. The EBITDA margin stood at 19%. Our EBITDA margin is lower than the previous period on account of business combination of Jampp business. Going ahead, we are confident of further optimizing the business model and platform of Jampp to enable margin expansion over the time. We will continue to invest in our team to deepen our market penetration and enhance our tech capabilities. We have recently floated our employee stock option scheme and granted options to team members of the group. The response from the team members is encouraging on the options granted. Our profit after tax for the quarter stood at 476 million, a year-on-year increase of 77.1%. Normalized profit after tax after adjusting gain on fair valuation of financial instrument was at 420 million, an increase of 56.3% year-on-year and 47% quarter-on-quarter. We remain focused on working capital management and continue to see robust cash flow from revenue. In this quarter, we utilized our IPO proceeds raised in 2019 for the stated purpose of working capital completely, for which we had sought an extension from our shareholders. With this, I end my presentation. Let's please open up the floor for the questions.
Thank you very much. Ladies and gentlemen, we will now begin the question answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. While the question queue is assembled, we will start with the question answer session from Mr. Aniket Pandey. Over to you, sir.
Thank you, Janice. Congrats, Anuj and Affle team on great performance. I had a couple of questions actually. So, what is revenue contribution and margin profile of Jampp acquisition in this quarter?
Hello.
Yes, sir.
Hello. Shall I
Please
repeat my
go
question?
ahead.
Yeah, I'll take this question. So we have about revenue contribution of above 30% on the consolidated basis coming from Jampp. and a PAT contribution coming about 10%, more than 10, a little more than 10% from Jam.
Okay. So, sir, right now is Jam's tech platform fully integrated into Affle's platform, and once Jam's tech platform is fully integrated into Affle's organic platform, okay, so will there be any redundancy between Jam's and Affle employees who are completely engaged in R&D process, and do you expect to repurpose this talent and realize some cost synergies from it?
Is Anuj on call?
Hello, sorry, I realized that my call was muted for some reason. Anyway, I'll take that question. So the integration of Jampp has been successful in the first quarter and the last basically 4 months plus that post the acquisition was completed, and we're very confident that the integrations that we have done and the plans that we had prior to the acquisition are working well. Consequently, what you see now within the Q2 itself, that not only have we managed to grow Jampp through upselling and cross-selling efforts, as well as we have managed to make it achieve a profitable contribution. So Jampp is still, when we acquired them, they were breaking even at best, and now within the first quarter we have achieved approximately 5% profitability on Jampp business. Now, as Kapil mentioned, that on revenue, the contribution is about 30%, and if that 30% of the revenue from Jampp is only achieving 5% profit, and the rest of the business of Affle on an organic basis has delivered robust overall continued momentum of growth, right? So just on an organic basis, we've seen very strong growth, almost 34% on revenues year on year, which is ahead of the industry growth trend, and on normalized PAT basis, 37% year-on-year growth has been realized organically. So in terms of going forward, even on the Jampp specific call that I had after the acquisition with the investors, I had mentioned that it will take us some time before we graduate Jampp's bottom line contribution to a higher to mid-teens to almost 20% plus in the next 1.5 to 2.5 years. So, I'm pretty confident that what we have done in Q2, where Jampp is at 5% profit contribution for the revenue that's powered through Jampp, we are already on a good track and trend to build on this momentum. And as we continue to do the further integrations of certain technology components as well as the business model enhancements, the outcomes that we have as per the playbook that works well for MediaSmart and Affle would also work well in the case of Jampp, and we are only getting better at it.
Okay. I had one last question, sir. So last quarter you had guided that Jampp is expected to be converted to 100% CPCU pricing model. Okay. So is this process complete? If not, then is there a still further scope of improving pricing per converted user for Jampp? Thank you.
Yes, I think in terms of upgrading the business model, I think it is fair to say that we have educated all the customers and also done the platform level initial changes. But in terms of driving the efficiencies at which that model is run, whether in terms of CPCU rate pricing or with respect to the margin profile of the business, I think there is still a lot of progressive room for improvement. And the way to look at it is that if Jampp is at 5% profit performance in terms of the EBITDA or bottom line contribution for its revenue, then our goals are very clear that within this financial year, with 2 more quarters to go, we hope to bring it up to high single digit contribution, and then going forward into next year bring it to mid-teens, and then the year after bring it closer to 20% plus. And that is the playbook that Affle had when we did the earlier acquisitions as well, and even for Jampp. So we will see further improvement, and that improvement will come with the further optimizations on the tech stack as well as on the business model. We think that the cultural integration, the business model integration, and the initial tech integration has already worked well, and it is already showing in the results. So we are very encouraged by how we have done in Q2 with respect to Jampp acquisition.
Sir, does that answer your question? Mr. Pandey?
Yes.
Thank you. We take the next question from the line of Manish Podar from Nippon India. Please go ahead.
Yeah. Hi, Anuj. Thanks for doing the call and congrats on the good set of numbers. So, primarily two questions. One is, if you look at, let's say, the base business ex Jampp, despite, let's say, we were at roughly 135 crores last year, and we are now at, let's say, 195 crores this quarter. So, but despite that, the operating leverage in the business doesn't really kick in. So, probably could you help me understand, are we passing out the incremental, pricing in terms to get more volumes, just to get the, this scale concept up here?
Yeah. Okay. Go ahead, Kapil.
Yeah. So the margins improvements, if you see, our gross margins are quite stable. Despite the dip in the gross margin is reflective of the Jampp acquisition and consolidation. Otherwise, our gross margins are stable, and the leverage of the efficiency which you are not seeing is getting invested in our human resource to expand our markets, to broaden our growth base, and we will continue to invest whatever leverages we are getting into expansion of the business. We have consistently maintained that Affle is a growth organization, and we will continue to invest in our processes as well as manpower to continue in growth momentum.
Yeah.
Okay.
And actually, even with that, I think the fact that the normalized PAT growth on year-on basis, this is 37% plus with respect to how we are performing. There is, even with the investments in growing our presence globally and planning for deeper verticalization execution across emerging markets as well as certain developed markets and certain verticals, this strategy is working really well, and we are seeing expansion in EBITDA and profit on the organic basis, even at the back of very strong and consistent investment in our own organic growth and expansion. And I think the focus of the company is really on the Affle 2.0 strategy, which is to grow the business consistently for the decade ahead. And I think the foundations in terms of the tech stack, the acquisitions, the IP portfolio, all of these investments are working really well. And now it is being backed up further with on-ground presence and growing our teams and capabilities in those markets so that we can establish increasing market leadership across key verticals where we are very strong. So it's a very consistent execution strategy, and I'm very happy with the way the team is responding and behaving. And with the recent stock option, plans, I think there's a lot of passion and spirit and pride with which the organization is executing. So I'm pretty happy with the way the execution on the ground is panning out across geographies.
Okay. That's helpful. And just one more thing. So the cash on books as on date, I think, is roughly about 550 odd crores. Can you probably help me understand, let's say, how this cash pool, let's say, would stand at the end of the year, or let's say, sometime next year?
So we would organically increasing our cash flow from operations in this kitty. However, if we decide to make any further investment in expanding the business, that will be a cash out. But that cannot be there cannot be a future guidance on that. But positively, there will be an increment in cash accruing into the balance sheet from the operations.
So, when is the outflow for JAMP expected?
So the outflow for JAM, the initial payment has been done in the month of June and some in July. So the next tranche is due in June. June 22.
June 22.
Yeah.
And so post that, if just to understand better, post that our cash on books would be somewhere in that 300 to 350 crores bracket.
So the next tranche is not a heavy tranche. Next tranche is only close to about 8 to 10 million, in the range of 8 million only.
Okay, that's helpful. Thank you.
So if I may just add, I think fundamentally the way I want you all to look at Affle is that we have historically always funded our acquisitions through internally accrued cash flows. And as we continue to grow our profitability and converting that into cash flow from operations, we will see that a lot of these payments will actually get funded through the operating cash flows on an ongoing basis. So we should have a continuously good cash position and a strong balance sheet. And when the right opportunity comes, we will do further investments, inorganic as well as organic, to deliver growth. So that's how we should look at it.
Thank you. The next question is from the line of Devesh Mehta from Dolat Capital. Please go ahead.
Hello, am I audible? Hello?
Yes, you are.
Thank you for taking my question. So my question was, in terms of margins of the previously acquired businesses, right, starting from MediaSmart, can you just give a rough idea of how and where they are in terms of their progress of margin improvement? And also with respect to JAMP, if our current profitability you said is around 5%, that is on PBIT level, right?
Yeah. So the like I mentioned earlier in my discourse, that every acquisition that we have done, if you look at the pattern of the acquisitions that Affle has done, we have acquired companies when they were at the break-even level or just at the cusp of turning towards profitability. And then we have a clear path that within year one, bring them to high single-digit level of profitability. Within year two of the acquisition, go to mid-teens and as high as possible. And by the time it's year three, we want them to be at the same quality of unit economics that we enjoy in our organic business, as well. So with respect to MediaSmart as well as Affle, for any prior acquisitions, whatever this phased plan is to improve the bottom line contribution of these business has worked really well for us. That gave us the confidence to then continue and do a bigger transaction with JAMP and a further transaction. The company that's based in North America, South America, and much further, and then the larger transaction size was backed by the fact that our execution on inorganic and the track record is solid, and it's inspired our confidence. Same thing we are seeing in JAMP now. And your question whether JAMP's 5% is a bit or PAT, I would say we are looking at it on both lenses. We very granularly tracking that, and it's about 5% on EBITDA and PAT both. It's not very dramatically different, but it's about 5%. You can take it as 5% EBITDA at this moment.
Okay. So in terms of previous acquisitions, how you have highlighted that they are well going on track, just to quantify it in some way, again, you cannot share exact numbers, but you are looking at that MediaSmart and Affle are already above like 10 to 15% on a PBIT or EBITDA level, or I don't want an exact number,
That's
but
correct.
some direction side.
That is correct. So both these acquisitions are now in year two, and we are aiming for mid to high teens in terms of contribution at the bottom line level. and it's going as per plan. And that's what I mentioned in our commentary, that all our organic as well as inorganic investments are performing well in terms of profitable growth momentum. So the momentum, the trend lines, all of this is doing well on every granular aspect that I look at for our investments that we have done, and I'm really confident that it's a broad-based growth happening across markets, across customer verticals, and our teams are well aligned to achieve those goals. And the KPIs, our incentives, now added with the stock options, are keeping the entire organization execution completely aligned to these goals.
Okay. So just to confirm, what you're highlighting is that on a margin level, they are somewhere between 10 to 15. That is right. And one last question. In terms of your expansion and other geographies, how are we doing there? Have there been any inroads and any qualitative word on any big client entry or anything where we can see that, okay, this year, any qualitative commentary in terms of us getting into some big clients or something which we can see on Apps Player to get an idea how we are progressing on that front?
Sure. So I think the qualitative aspect can be seen with the fact that we are having our key platforms and tracking and consolidated, achieving very strong recognition, whether it's the industry indexes or whether it is the industry awards, the kind of campaigns, customers getting the wins and accolades consistently, as well as indicated qualitatively in the case studies that we have shared. So in the last earnings presentation, we have shared 3 case studies. This time we have added 3 additional case studies to give you a much clearer qualitative sense of what's happening on the platform, what are the capabilities that Affle has, how are the customers benefiting, and so we are trying to ensure that you build a deeper appreciation of what is fundamentally happening at Affle beyond just financial numbers and so on. So I think there is a consistent effort from our side to ensure that our investors deeply appreciate and understand the power of our platform and how we are doing across emerging markets and not just India. Indonesia case studies were shared, Malaysia case studies were shared, and I think progressively we are also looking at the planning of the analyst day, which will come soon, that we will share more insights into more markets. But very broad-based growth, the verticalization strategy is working, and it's really strengthening our moat and building our confidence to go ahead and invest into people on-ground presence in those markets. We will only do that when we are absolutely sure. So when all our investments are done very prudently, whether they are organic or inorganic. So the fact that we are investing in global expansion to those markets is a very strong indicator that things are working well, our platform is delivering, our strategies are working, and therefore we are investing to grow and scale deeper in multiple geographies.
Thank you. The next question is from the line of Arun Prashant from Spark Capital. Please go ahead.
Yeah, thank you. I hope I'm audible. So the first question is on the recent case filed against Google by a group of interested parties in Texas, where it is alleged that the Google's demand-side platform has unfair advantage and it engaged in anti-competitive practices. So, in the context of India, what is your current opinion on this issue? If you could elaborate a little bit on this, and then as a follow-up to that question, assuming that the level playing field is created as a result of this litigation, can you explain this scenario by taking us through, say, an hypothetical campaign where someone like Affle, how it can benefit from this favorable outcome?
Sure. I think I will take the opportunity to share with all the members on the call that Affle has a 16 years of history in this ecosystem, focused exclusively on mobile marketing. Unlike other companies, I could say that we haven't really pivoted or needed to pivot. I think mobile marketing has been an anchoring focus and consistent vision of the company till now. And the ecosystem has gone through tremendous changes and adaptations over these 15 years. Right from when we started, it was before Google had acquired Android, before Apple had launched anything on the iPhone, and Nokia was king and BlackBerry was cool. Apple was still doing mobile marketing. We saw a massive change with the touch screen form factor of devices, and we all know that a lot of changes have happened in the ecosystem, but Apple has maintained a very, very strong execution track record to maneuver through various changes, and the entrepreneurial culture that we have, keeping ahead with tech innovations consistently, has really helped us to maneuver through any kinds of changes. In the last 5 to 6 years, we have seen data privacy coming in Europe and GDPR in Singapore, Personal Data Protection Act. In the next few years, we'll see that as well. And most recently, there was nervousness around iOS 14 and related policies, and we have shown that we had the foresight to do the Jampp acquisition. We knew that there were some of the things that they and we were working on that can be leveraged in order to make a head start into the new sort of iOS 14 territory, and our Jampp platform has consequently seen that recognition as a top 10 global platform on SCAN network. What I'm trying to establish is that based on Apple's historical credentials, you can see that we have a very strong track record of maneuvering through any changes that are happening at the ecosystem level. Now, with respect to Google and Facebook, Apple's view is that we operate in an ecosystem where we are still biotic. We are not head-on competing or fighting against Google or Facebook. On the contrary, we in fact integrate our tech stack on Google, Facebook, so that we see it as a platform where we can find consumer audiences and drive conversions for our customers from their touch points as well. So I am very neutral to what happens exactly, whether Google and Facebook or platforms like that will see any further clipping of wings by regulation or these checks and balances of how much they have or they don't have. My long-term view is that the non-Google, Facebook part of the ecosystem will continue to grow at least at par with the total digital advertising growth, if not much better, over time. And that's to do with the fact that I think that the advertisers have over-allocated their budget on Google and Facebook so far, and there is a lot more competent platforms with complementing capabilities that can drive higher ROI and value for the advertisers over time. So we will see that all of these platforms will continue to grow, but the non-Google, Facebook part, in my opinion, should grow faster for multiple factors. And specific to what's happening in India, let's wait for the outcomes of these cases and so on, and we are equally watching it with interest and preparing ourselves for all opportunities and possibilities.
That is very helpful, Anuj. But I just wanted to specifically understand how much of our currently, say, our performance or our growth rates would be different if this level playing field is already there. If you can take a wild guess.
The way I look at it is that the average industry growth rate in India for digital should be in the range of 25 to 30% CAGR for next several years to come. That is all in comparison, right? Facebook, Google, everything is in that. And I believe that Apple will continue to grow better, hopefully, than the average industry growth trend. The last several years already show that. The CAGR growth of our Q2 revenue is 65.7% over the last 3 years, and even if you slice and dice into Jampp versus non-Jampp, still you'll find it as a very fantastic growth trend. So I think we're already doing very well. Can we continue to do as well? I'm very confident, bullish about it. Can we up it further and improve it further? Let's wait and see. Let's not simulate the scenarios that have not happened entirely. But I think even if the status quo stays, I think we will continue to do better than the average industry growth rate, hopefully. And if the status quo shifts in favor of non-Google and Facebook, of course, we will take advantage of that.
Thank you. The next question is from the line of Rishit from Nippon India. Please go ahead. Rishit, you may please go ahead with your question. As there's no response from the current participant, we take the next question from the line of Sanjay Ladha from MG Investment. Please go ahead.
Hello.
So you
Hello.
may please go ahead with your question.
Yeah. Very good set of numbers, sir. Just wanted to ask a question like in the previous interaction, you have mentioned that inventory and data cost would be in the range of 55 to 58% of the sales. While in this quarter and half year, this ratio has increased. Can you throw some light on how should we look this ratio going forward, and why there is so increase in inventory and data cost, and what are our strategy for the same going ahead?
Should I take this, Anuj?
Please go ahead, Kapil.
So, as you would have seen in our earnings presentation, we have consolidated Jampp business in the Affle business. It's a consolidated financial. And the Jampp acquisition commentary, which was the call which was done early in June and July, the margins on the Jampp business are significantly lower on the gross margins than what Affle earns. So there is an impact of 4 to 5 basis points coming in. Overall impact is coming on only from Jampp. If I see excluding Jampp, I made this point in my earlier answer also. There is no impact on the gross margins on the non-Jampp business of the company. So we have in fact increased 100 basis points over the last year performance on the gross margin in the organic business.
So, sir, how should we look going forward this ratio? So, in like suppose in coming 2 to 3 quarters, this ratio can be come down to 58%, or this will be elevated?
It will not improve in next 2 to 3 quarters, as Anuj mentioned previously also. It will improve from here. But to say that it will come down to what Affle prior to Jampp acquisition in next 2 to 3 quarters, it will not be. Yes, we will try to improve the business model to an extent that we in a say 4 to 5 quarters or maybe 6 quarters down the line, we may come down to close to what we want. Overall business, that including the Jampp business.
Thank you. The next question is from the line of Mayank Babla from Dalal & Broacha. Please go ahead. So you may please go ahead with your question. As there's no response from the current participant, we take the next question from the line of Alisha Mahawala from Envision Capital. Please go ahead.
Hi, sir. Good morning, and thank you for taking my question. Sir, I'd just like to understand that our average CPCU has been in the range of 40 to 41 rupees, and this quarter it has spiked to 50 rupees plus. Just wanted to understand the reason behind the same.
Sure. Typically, the CPCU rate is balanced based on the function of business contributions in India and international markets. International markets typically have a slightly higher CPCU rate compared to what we would see in India. And this quarter, because our contribution for international business is higher, consequently the CPCU rate average has gone up to the level that you're seeing now. And we believe that we can sustain this level of contribution. And as the Indian international mix stabilizes, we see the CPCU stabilizing. As we improve the verticalization strategy across the newer markets where we are executing, we will have capability to also improve the CPCU rate further. And we will provide progressive explanations on that as any shifts happen. So, but for now, The way we see it is that until now it was hovering at around 40 rupees to 42 rupees. Now it's gone above 50 rupees. The function contributing to that is that there is a higher contribution of international business, and therefore the average is moving up at this moment. And I expect it to hover around this and then improve it further progressively with our verticalization strategy and executing deeper within the international geographies.
Understood. That was well explained. So just wanted to clarify that while you had mentioned earlier in the call that contribution from India and international used to be 50-50 and now is tilting in favor of international, where do we expect this mix to sort of stabilize, like you said, once verticalization and full integration of Jamp, etc. takes place? Are we saying it will be this 63-33 or are we saying it will be 70-30 or any other number?
It's hard to give that specifically, but I will certainly say that India is our home ground, it's our home market, and I would expect it to continue to contribute around 30% plus to our business. We are single largest contributing market, and then the international business, as you already know, it's about 66% now. But because the number of markets and geographies that we will continue to invest further into and grow, we will see a higher addressable market size in the international business, while India will continue to be the anchoring market for us. And a lot of our innovations and strategies are almost always first rolled out in India, whether it's the connected TV product, whether it is the connected household IDs, or whether it is the omni-channel platforms. We see, our emphasis on executing deeply in India, be it the vernacular strategy or verticalization. So our focus on India execution is disproportionately high, and the teams on the ground which are looking at India, they are 100% focused only on India. And the teams that are looking at other international geographies, we're also bringing market-specific execution focus on those geographies so that we can, there's no dilution of focus happening in terms of depth of execution, be it on India or Southeast Asia or Middle East Africa or Latam or the verticalized focus in developed markets as well. So we are very clear about our execution strategy, and this contribution will be a function of how business expansion continues to happen. But for now, I think we can say that this it should hover in the range of 30+% for India.
Understood. Sure. So my next question is with respect to converted users. We see very strong Q-on-Q and YOY growth if you look at full year basis or even if you look at track it on quarterly basis. Just wanted to understand, where is this growth coming from? Is this simply expanding into newer geographies, or now that we have some proof of concept and foot in the door, we're getting more business from the same clients? Any color you can share on the same?
Sure. See, first and foremost, the macro factors in the industry will continue to be very favorable. It is active tailwinds for growth of this business model of converted users, because more and more users, at least in emerging markets, are going on to becoming online shoppers for all kinds of lifestyle products and services across industry verticals. So the consumer trend is very, very strong, and I think it's a multi-year trend. COVID has accelerated it, and we expect that to continue, because once people are hooked on to digital, I think it's a trend that stays and it continues to accelerate. So that's one. Then in terms of the advertisers, the industry verticals that we are working on and the clear strategy and verticalization that we are seeing increasingly direct advertisers working with us for almost 74% of our revenues. This strategy is working very well on a broad basis across the top verticals, contributing over 90% of the revenues. And then within those verticals, we see existing customers, new customers, and our sales teams, and we are consistently pushing for growth on those parameters. And this is happening across geos. It's happening for us in India. It's happening for us across international markets. So what gives me great confidence is that the growth is very broad-based. It is not that, oh, suddenly one customer has become really big or one particular contract has become really big. It's a very broad-based growth coming across verticals, across geographies, from existing and new customers, and that is really sustainable in my opinion. I think the engine of growth is working and the momentum is strong.
Thank you. The next question is from the line of Mayank Babla from Dalal & Broacha. Please go ahead.
Hi, thank you for taking my question. Sorry, I was on mute earlier. Congratulations on a great set of numbers, Anuj and Kapil sir. Very good execution. I had three questions primarily. One was if you could categorically give the converted users in the organic business and what was the contribution from Jampp in the converted users this time. That was one.
Okay. All right. So I think the contribution for Jampp on converted user basis is not something that we have published in our earnings report. But it was suffice to say that international markets, the CPCU rates are higher and the number of conversions is not so high, right? So in terms of the math of it, and in terms of the contribution from organic business is more than 80%. Actually, hovering close to 90% is coming from organic business conversions, and 10% and less than 20% coming from the inorganic. The focus of the company as we go forward will continue to be on the converted and conversion-based ROI-focused business model as we execute and expand our business across the board. And we are seeing a very strong uptick of this business model. And what has really encouraged us is that we are able to execute on this business model even on certain verticals in developed markets on iOS as well. And I think that is extremely encouraging and something to be looking forward to as we continue to scale and expand.
Sure. Okay. Thank you for that. My second question is regarding Jampp itself. So, sir, we've seen a strong growth in this quarterly run rate, while CY20, the annual run rate of Jampp was around $29.5 million, which roughly converts into 545 million rupees. This time the contribution, as you said, was 30% of revenue, which is around 800 million, roughly 800 million rupees. So my question to you was, what is this a normalized growth rate, or what is a normalized run rate that we can assume so that we can get a sense on the future earnings?
Sure. Let me answer that qualitatively for you first so that we can understand what is happening much better from a ground execution perspective. Prior to the acquisition, Jampp was in a tough spot. They were not profitable, certainly not cash flow positive, and they were therefore playing on the back foot. There was COVID impact across a lot of their markets, and key customers of theirs were down because of COVID. There's a lot of their customers were on on-demand services, food delivery, taxi. When things were really shut down in some of the markets, some of the quarters they had a bad time. And therefore, from a management execution mindset, it was a survival mode. Or if I may call it, from a cricket analogy, playing on the back foot just to keep wickets in hand, and not really trying to score a lot of runs. So I think they were just on the back foot. With the acquisition, I think we have been able to bring the entrepreneurial culture on the forefront, the growth mindset, the go ahead and get the business, and the fact that they are back in the limelight, there's cash in the bank account of the company, the baggage of dealing with conflicted interests of all kinds of investors they have in the cap, all that is gone. Now it's just Affle. There is money in the bank and there is clarity of direction. And so think of it from a very defensive play to keep the wickets to actually, let's go and score. And that is what has changed. And I think that's when I say the cultural integration has worked well. The Financial integration has worked well. I mean, we've got the audits and compliances achieved within very short span within the first quarter across geographies and so on. And the tech integration has also worked well, which is leading to better sell-through rate, better extraction of budgets from the customers, because now you're going and proposing a broader set of capabilities and so on. And then we are consequently seeing the impact on profitability as well. So I think there is growth on all fronts, including growth on team costs. So we are investing. I mean, in the case of Jam, the team has grown, and we have really shown them the growth path. And profitable growth momentum is the key word. And so continuing to grow is important. So what you're seeing now is let's say the correct reflection of where the business should have been. And if you look at calendar year 20, had they had better funding, more clear strategy, then they would have probably done better in that year. So we had analyzed all of that, and when we acquired the business, the thesis was clear that how we will turn it around by bringing additional scale, growth, better business model, better pricing efficiency, and then one step at a time improve its profitability. Now, where it is now, I would want to focus on enhancing its profitability metrics versus just scaling with a 5% contribution on the time back. This is something, the priorities are clear. Get the unit economics to a better place, and of course continue to scale. But the priority number one is get the unit economics right. So I'm not giving you any guidance of continuous growth momentum, and if we over deliver on that, that's something to celebrate. I think the focus and priority on execution is clear. Improve the unit economics and scale sensibly through internally accrued positive cash flows that are generated in the business. And I think that's the best way to answer it at the moment.
Thank you. Before we take the next question, a reminder to the participants, please limit your question to one per participant. You may rejoin the question queue if you have a follow-up. The next question is from the line of Ruchi Burde from BOB Capital. Please go ahead.
Congratulations to the team for the excellent set of numbers. I have questions starting with the iOS policy changes. I know this forum has discussed it a lot, but trust me, we get a lot of questions on this. So, Anuj, in US with the iOS policy changes, we saw a very diverse impact on the businesses of digital advertisers there, wherein the Android ecosystem benefited a lot with in terms of rate increases. Did you also experience the same? Any comments on that?
I'll make two comments on this. One, that Apple is really strongly anchored on emerging markets, which consequently makes us very strong on Android. And secondly, the fact that we had done the acquisition of Jampp and the timing of the acquisition, if you look back, it's around the time when iOS 14 is being rolled out, and we said we want to take the opportunity head on and grow in that segment at the back of our credentials that as Apple Group, we are very strong in Android. Now, when the advertisers became shaky on, okay, what's going to happen on iOS and so on, they were looking for partners who are very strong in Android, and we came out, hey, we are the strong players from emerging markets in Android. Choose us, select us. Plus, we have now on-ground presence in North America, where iOS 14 impact is really the strongest. And we had differentiated capabilities that we rolled out for the advertisers to give them confidence on both fronts. That, hey, as an advertiser, you want to reach out to consumers broadly and drive ROI. They were shaky on iOS, where we came with some innovation and we said, hey, we have something for you here. And if they were thinking that they were shaky on iOS and they were shifting any budgets to Android, then again we could solve that and say, yes, Android, this is our home ground, from emerging markets. I think it really worked to our advantage. And this is what I was saying earlier. Whenever a change happens, which is an ecosystem level change, the organizations that have entrepreneurial agility and culture, the organizations who have tech innovation bag capabilities, which are preemptive in nature, and we're always investing ahead. We're not reacting that something has happened and we quickly scramble to come up with something. We're always investing ahead. And both those combinations with clear execution focus, is is the way that Apple has maneuvered and made the most of this opportunity. We have benefited on Android and we have also benefited on iOS. And that is shown in the results. And that's where some of the people who were underscoring and undercalibrating that felt that, hey, this is overperformance. But, I think this is the right level of performance based on the execution strategies we put in place.
That's really great to hear. Anuj, I know, we are predominantly Android, we operate in Android dominated market. But even if you look at, subset in India also, the iOS would make up, if not more, at least a low double digit number mix. So if you look in your device set, how was your experience for the iOS devices in the last quarter? Did you see any drop in the efficacy of your platform, especially for the iOS devices, or it wasn't material?
So I wouldn't say that the change was immaterial. I think the industry has seen that the change is material. But with that material change, there are some fundamentals of our industry that won't change, right? The advertisers' budgets did not shrink. The advertisers' budget going to digital is only increasing. Now, whether it is going to Android or iOS or it's going to Google, Facebook or not, it's all round growth, right? In terms of advertisers wanting to spend on digital to connect with consumers. That macro trend is a pillar of strength because the demand for digital advertising from the businesses, small and large across verticals and markets, is very, very strong. Next is the consumer trend. The consumer who is still using the iOS device is still a valuable consumer and the consumer is going to do conversions from the mobile phone. Whether this way or that way, the consumers are also deeply married to their devices. And so these two sides of the ecosystem, on one side the advertisers' budgets are there, on the other side consumers are not leaving the screen. Then the rest of it is technical execution. That this has changed. You got to adapt and make it happen. And I think what we've seen is that those who are able to adapt are rising faster. Those who are not able to adapt will scramble through and adjust hopefully in time. And I think for us, like I mentioned, we've benefited on both sides, on iOS as well as on Android. And I'm pretty confident that we'll continue to improve and execute better going forward. So the nervousness or risk around the change is behind us because we have, crossed that hurdle with strong outcomes. And I think that builds confidence because we're seeing customers across verticals. It's a huge booster in our own conviction of where we are headed.
Thank you. The next question is from the line of Rahul Jain from Dolat Capital. Please go ahead.
Yeah, hi. Thanks for the opportunity and congratulations on great set of numbers. Most of my question has been answered. Just one or two things I would like to clarify. First of all, you explained well on the jam, what kind of outlook and thinking we should have. But from a more sustainable point of view, given the kind of market it is playing and with the cultural shift that you spoke about, what are the ideal, range of growth rate it should aspire for? Because the market opportunity could be a little different compared to what we have, that 25-30% kind of a mindset at the corporate level. So any input on that would be of help.
Sure. The underlying assessment for any acquisition that Apple does, and this is our internal sort of assessment, and I'm sharing that with you so that not only does it apply to Jampp or our earlier acquisitions, but also in future, if we do any acquisitions, the playbook is very clear. One, we will only acquire those businesses that we believe we can continue to build and grow with the kind of growth momentum that we expect from Apple overall, which is to beat the industry growth trend. And the 25 to 30% CAGR growth that we have seen on a broad basis for digital advertising, we expect every part of our business to grow that way. That's one. Secondly, we expect to turn around the acquired businesses where they are breaking even or struggling to make them profitable over this period of time, and for that we give ourselves about 2 to 3 years to bring them to a high teens or 20% plus EBITDA kind of a margin performance over that period of time. Now, so earlier we were talking about Jam from bottom line perspective. Now you're asking about Jam from a top line growth perspective, and there, let's say 1 year, give us 1 year plus to make sure the unit economics leads to a level where the growth is organically funded through profitable cash flows, and we need to solve the unit economics on priority number 1. And then the next priority comes where we get to the same level of CAGR growth rate for the future, which should be hopefully at least 20%, if not higher, and then grow it to 25 to 30% CAGR for the longer term.
Thank you. Just last one question. From your capital that you have available, a significant part of it. So are we at a point, given the stability of in the Jampp integration process, that we are ready for a big acquisition if it comes our way? That is point one. Second, in the standalone operations in this quarter, we have seen significant jump in the inventory and data cost, 25%. So is it because we might have some optimization in terms of booking this cost at a enterprise level in the standalone operation, or is it only relevant for the standalone revenues? Thank you.
Okay, I think for your first question with respect to bandwidth, whether it is financial bandwidth to pursue another acquisition or management bandwidth to pursue another acquisition, let me assure you that the acquisition of Jampp has only increased our management bandwidth and capability, not consumed or entangled it. The quality of the management team of Jampp is strong. The top leadership and the depth of it is strong. And the fact that we now have a very strong management team that's aligned with us for the long term in those geographies is actually a big advantage of the acquisition. And therefore, the ability for us to do any acquisition, whether in terms of financial bandwidth or in terms of management bandwidth, that is strong. Having said that, we are very, very prudent with respect to the acquisitions that we do, the investments that we do, and we have learned over time that there is doing a wise and carefully calibrated acquisition is more important than just doing one. So there is no undue pressure or stress that, hey, there's cash sitting there, better do something, or you have bandwidth, so why don't you do something? If we find the right target, I assure you we will do it. And finding the right target has many, many factors that one has to see, and we will carefully calibrate it. So there's no short-term or medium-term guidance to this, but the readiness is there and the capability is there and the options are there. And we will choose the right time to do it. So that's one. The second part of your question, quite frankly, standalone and call, I didn't quite understand. Kapil, if you have understood it, can you answer that?
So I will take this question. You were comparing the data inventory cost on a sequential basis in standalone. I would request you if you compare it on YoY basis, because every quarter has its own nuances and availability of the inventory and the cost associated with it. So your comparison with sequential, I would request if you can compare it with the YoY September standalone. You will find that the matrix is intact. Hello, does that answer your question?
Thank you. Before we take the next question, a reminder to the participants, please limit your question to one per participant. The next question is from the line of Sumit Choksey from Indus Equity. Please go ahead.
Yes, thank you. Am I audible?
Yes, you are.
Yeah, thank you. So my commendations to you, Mr. Khanna Soham, and the rest of the team on an excellent set of numbers. So I'll just limit my question to one, and it's slightly elaborate, so do bear with me. Now, this pertains to Affle's future growth narrative. So far, the company's been largely focused on, visual advertising as a medium. But today, what we're seeing is advertising purely through voice-based mediums is growing as well. And we see, for example, Spotify provides voice-based ads in its free version prior to song streaming. and you're also seeing conversational e-commerce purchasing itself is growing extremely rapidly. So bearing this in mind, do you foresee this is a business opportunity for Affle? Is this something you all believe you all can address through your R&D capabilities? And would it be fair to say that the Affle 2.0 strategy could accommodate a third V besides verticalization and vernacular in the form of voice? This alludes largely also on the banks of your podcast-based IP. So if you could just shed some flavor on that, that would be great.
Well, that's a great question, and thanks for your references to our 2V strategy of Affle 2.0 as well as our voice-based podcast patent that we've got in the US market. It's absolutely right that this is a growth opportunity for us, where we look at connected households and connected devices. So here I'm just elaborating to give you a vision and or a very human sense of how consumers and all of us will behave going forward. Our households will have voice-based devices. Our wearable devices will also have voice commands. We'll be changing the lights and the fan speeds and the air con turn off and all that. Home automation is going to happen over the next several years. Our cars will have these capabilities and so on and so forth. So while the mobile device and the connected TV device will continue to be strong visually led devices and will form a big part of the consumer experience for next 3 to 5 years, there will be increasing number of wearable devices, home automation connected devices that will come, where the interactions would be different, where we would be listening to it, or we will be giving visual commands to it, or when we are listening to something, for example, if you're listening to music. None of us would necessarily want to interrupt that experience by having an ad playing between the songs. Whether you're listening to a bhajan or a Bollywood or a Hollywood or a, whatever kind of music that you may love or like, we don't want a sudden out of context audio ad playing in between, right? There will be components of visual advertising together with the voice-based experiences and integrated experiences will come. And one of the ways to deal with it, for example, you're driving a car and you see something on the screen, you listen to something with your ears, neither can you touch it, nor do you want to interrupt by speaking into it because there's another audio playing. So using gestures to then do a command to say I'm interested in something, or I like this, just keep it for later, I'll look into it, or using some smart gestures. And I think those are the kind of use cases and consumer behavior use cases that Affle has already done research on, has patent on, a patent that's already granted, which I think is a clear indicator that not only are we giving lip service to future trends, we are investing into them and we are building competitive moat on that preemptively before these become big market opportunities. The fact that we already launched our connected TV, connected household initiatives last year in India is indicative of that, because the market is clearly very, very nascent. But we have already launched products, invested in that. So we are ahead of the curve and we are excited about these possibilities. But next 3 to 5 years, I can assure you, visual ads is not going anywhere. It's only going to continue to grow, and voice will be nascent, small, but an exciting space. And we love to be in exciting spaces. That's what we like about our industry, and we will definitely continue to see that as an opportunity and build IP in that area. So yes, the third V, you could say voice, or vernacular, verticalization, voice, and the fourth we have a case study, video ads, and so on. So we are holistic in our thinking and our strategy.
Thank you so much for that. I'll just quickly ask one follow up. I'm cognizant that we should be asking only one, but just with regards to your new patents, which you all did file in the USA regarding the blockchain IP for fraud detection and the podcast-based IP. Do you see this bringing in revenue anytime soon, or could you give some sense on that?
See, I want you to, and all investors to know that IP and patents, these are foundational blocks of any tech innovative company. And these are strong indicators about the future of the company. What is it that we have IP for? What are we building? What is Affle investing in? What are the directional things that are happening? And you see that. And then why do we go and apply it in US? Because US is one market where these IPs are most valuable. I mean, this is one of the largest markets in the world. So even though we are not necessarily, on the ground executing, we want to make sure our IP and innovations are recognized, registered over there, because that's where it is most valuable. And of course, we can then command revenue possibilities over time over there. So it's lesser about immediate revenue and financial. It's more about strategic, long-term, sustainable growth direction of the company and reflecting the culture of the organization. That we are creating. We are inventors first, then we are entrepreneurs. So we invent new things, then we go and execute and commercialize it as entrepreneurs, and then we execute for scale and growth in market leadership and thought leadership. So those are these steps. And the patents that we have filed, whether granted or not, are indicative of that. It is also defensive strategy where some of the larger companies who have patents, they sometimes try to muscle out or throw patent walls at companies to keep them out. And we want to make sure that we can neutralize that by having our own set of patent portfolios to counter that, when that happens. It also works as a deterrent. In case somebody goes, anti-us on some patents, we can counter at that and say, look, on your home ground, we have all these patents, so better watch out. We don't. So there is there's forward-looking foundational strategy in the IP portfolio, and there's also defensive strategy in the IP portfolio, and we cover both grounds with what we have done. It's not just about short-term what's happening to revenue and profit with that. I think it's a decade-long view for us for Affle 2.0 strategy, and this is how you should see IP and patent-related updates from us.
Understood. Thank you so much.
Thank you. Ladies and gentlemen, due to paucity of time, we take that as a last question for today. I would now like to hand the conference back to the management for their closing comments.
Well, thank you so much for joining the call today. I would like to congratulate all our shareholders and also for those who are interested in evaluating Affle as an investment, that this Q2 result is a landmark performance, and it's deeply anchored and a validation of our entrepreneurial culture, tech innovation, and continuous execution focus on the Affle 2.0 strategies. So looking forward to updating you more as we progress in the next 2 quarters of this financial year. All the best and take care.
Thank you.
Thank you. On behalf of Prabhudas Lilladher, we conclude today's conference. Thank you all for joining. You may now disconnect your lines.